Now that we are done with financial markets and financial assets, we're going to talk about financial intermediaries. Just like what I said in the first part of the video, financial intermediaries are financial institutions through which savers can indirectly provide funds to borrowers. So there are four main types of financial intermediaries that we're going to learn today. So first, bank. 2. Mutual funds. 3. Pension funds. And lastly, life insurance companies. The first financial intermediaries that we're going to learn about is bank. Bank is probably the most familiar and the easiest financial intermediary above all because we have an easy access to banks in our daily lives. So there are two major tasks that a bank as a financial intermediary does. So first, it accepts deposits from savers, which basically gives a claim to savers on a bank that makes the bank to give the savers their cash whenever they need the money. The second task of a bank as financial intermediary is to make loans to borrowers. We already covered this part, but I'm going to go over again. So basically, banks cover their costs and make profits by charging a higher interest rate on their loans than they pay on their deposits. The second financial intermediary that we're going to learn about is mutual fund. A mutual fund is nothing more than a collection of stocks and or bonds. You can think of a mutual bond as a company that brings together a group of people and invests money in stocks, bonds, and other securities, like loan-backed securities. Each investor owns shares which represent a proportion of the holdings in the fund. So let's say I want to invest in stocks, but I have limited amount of money. Then I find mutual fund that can buy several stocks offering moderate income. My investment is thus pooled with others because my funds have been pooled through a mutual fund. Just like loan-backed securities, mutual funds utilize diversification that minimizes the risks of securities potentially struggling. Mutual funds are operated by money managers or fund managers who invest in the fund's capital and attempt to produce capital gains and income for the fund's investors. The third financial intermediary is pension fund. Pension fund is short and easy when we understand what pension really is. So pension is basically an economic activity that prepares for you in the future when you retire from your job. So pension fund is one type of mutual fund that invests in various different assets so that in the future, after one retires, as I said, he or she can still earn an income. The last financial intermediary that we're going to learn about is life insurance companies. Life insurance companies is quite self-explanatory. Life insurance companies are types of intermediaries that sell policies to people where they can be guaranteed to provide their family members with a safeguard, a financial protection from financial impact after once their death. So for example, if I am a patriarch and probably I am the only one who brings home the bacon, then when I die from a disease, for example, there will be no one to, and there will be, let's say, no one to look after my family members. A life insurance companies take place where they will provide money because of my deaths, so that my family members do not have to worry about the financial aftermath when I die. So this was all for my second video about financial system, financial markets, and financial intermediaries. Hope you liked my video, and have a great day.